lesson, the aim is to learn about how to process sales and purchase returns. You need to be able to double enter returns for both sales and purchases and for cash and credit transactions. Sometimes stock needs to be returned. Perhaps it's faulty, not expected, or not needed anymore. Have you returned goods? If you have, you've probably noticed that the business insists that the refund is provided using the same method in which you paid. This is actually a procedure to deter fraud, but it also helps the business to account correctly for the refund. To account for returns, the business usually reverses the original transaction. The sale was recorded as income and the cost of stock was recorded as an expense. When goods are returned, the transaction needs to be reversed or removed. For cash transactions, a refund can be provided using the bank or cash account. For credit transactions, a credit note is issued which reverses the invoice that was posted, so it reduces the amount of debt owed. Get ready to pause the video to give yourself time to read and answer the question. The business has recorded that it sold £500,000 worth of goods so far. This needs to be reduced by £5 for the item that has been returned. The business is holding £100 cash. The customer is refunded using the method in which they paid. The cash balance will reduce to £95. Later in your studies, you'll learn that these little transactions are actually grouped together and recorded in bulk, usually at the end of the day, rather than a chicken at a time. As a reminder, throughout this lesson, we'll be using the mnemonic dead click to help us double enter accurately. I've listed the accounts we will be using. You might want to make a note of them before we move on. You've learned that the sales account is an income account and a credit record, so the opening balance is on the credit side. To reduce the balance on an income account, we make an entry on the debit side. So the refund is recorded as a debit. This gives the account balance we are expecting, £499,995. It's perfectly acceptable to account for returns like that. However, businesses like to separate sales and sales returns. The sales returns account is a debit record, as it provides a place to enter the transactions that would normally be entered on the debit side of the sales account. We can see here that the business has actually already recorded £24,995 worth of returns. Returning the chicken will increase the amount to £25,000. The figure that will be entered into the statement of profit or loss is calculated by totalling each account and deducting one total from the other. The actual figure to be entered in the statement of profit or loss is £475,000. Separating returns from sales provides the business with more helpful information. For example, they're likely to measure quality by comparing what's been returned to what's been sold. If we put all of the transactions into one account, this comparison would be more difficult to do. Get ready to pause the video to give yourself time to read and answer the question. The return is added to the sales returns account, giving a revised balance of £25,100. The revised total for sales is calculated as total sales less sales returns, giving us £474,900. The refunds are provided through the bank, which will reduce the bank balance to £69,995. £900. Get ready to pause the video to give yourself time to read and answer the question. The sales returns account provides the debit side of the income account, so the opening balance is on the debit side. The return is added to the opening balance with a debit entry. The balance on the account is now £25,100. The bank is a debit record too, as whilst we are learning, we assume there's money in the bank, asset of cash. The bank balance needs reducing with a credit entry. Get ready to pause the video to give yourself time to read and answer the question. The return is recorded in the sales returns account. So the total for sales returns increases to £500. The revised sales figure for the statement of profit or loss is now £74,500. The business invoiced the customer for the taps, so the debt is in the customer's debt account. It needs removing. Customers now owe £4,800. Get ready to pause the video to give yourself time to read and answer the question. The sales returns account is a debit record with a debit opening balance. We add £200 to the opening balance with a debit entry. The balance is now £500. The customer's debt account is also a debit record as it's a business asset. To reduce the amount customers owe, we credit it. The balance on this account is now £4,800. We never use the debit side of the sales account. Get ready to pause the video to give yourself time to read and answer the question. The sales returns account is a debit record. The opening balance is on the debit side. We need to add the additional returns to it with a debit entry. Credit customers were invoiced £500 for the goods they returned, so the invoice is in the customer's debt account. The account is an asset account, a debit record with an opening balance on the debit side. We need to reduce the debt owed, so we make a credit entry. The customers that paid immediately for the goods need to be refunded through the bank. The bank is a debit record, so we credit it to reduce the asset of cash. Did you check that the entries balance? We account for purchase returns in exactly the same way. All returns are added to the purchase returns account, and the equal and opposite entry will depend on whether the business paid the supplier immediately for the purchase or whether they were invoiced on credit. Before we do more questions, let's remind ourselves that the supplier's debt account is a liability account, a credit record with an opening balance on the credit side. We assume there's money in the bank, so the asset of cash is recorded on the debit side of the bank account. Purchases are an expense, a debit record with an opening balance on the debit side. The purchase returns account provides the credit side of the purchases account, so the opening balance will be on the credit side. Get ready to pause the video to give yourself time to read and answer the question. All of the returns are added to the purchase returns account, giving a revised balance of £1,550. The revised balance for total purchases is £48,450. £150 will be refunded to the bank account. The refund will increase the bank balance, so the revised bank balance is £7,350. The wholesaler invoiced the business £1,000. The invoice will be in the supplier's debt account. This needs removing. The balance will decrease by £1,000, so the business will now owe its suppliers £3,000. Get ready to pause the video to give yourself time to read and answer the question. All of the returns are added to the purchase returns account. Let's remember the purchases account is an expense account, a debit record with an opening balance on the debit side, and the returns account provides the credit side of this account. The cash refund is debited to the bank account to increase the bank balance, the asset of cash. The invoice for the credit purchase is on the credit side of the supplier debt account. The liability needs removing with a debit entry. Finally, always check that the entries balance. The total of the debit entries equal the total of the credit entries. Get ready to pause the video to give yourself time to read and answer the question. Purchases are an expense, a debit record. The purchase returns account provides the credit entry for this account. We add all the purchase returns to the purchase returns account with a debit entry. The refund is debited to the bank account to increase the bank balance, the asset of cash. The invoice, the liability, is on the credit side of the supplier's debt account. It needs removing with a debit entry. Finally, did you check that the entries balance? Get ready to pause the video to give yourself time to read and answer the question. The sales account is an income account, a credit record. The sales returns is its opposite. We add all of the sales returns to the sales returns account with a debit entry. The refund for the cash sale is provided through the bank account. It's credited to reduce the asset of cash. The invoice for the credit sale is on the debit side of the customer's debt account, an asset account with a debit opening balance. We reduce the debt with a credit entry. Finally, did you check the entries balance? I hope you've enjoyed learning about how to account for sales and purchase returns in the double entry bookkeeping system. The next lesson is the final lesson, and we'll be looking at how to balance accounts properly and how to identify the figure that is recorded in the financial statements.